The system was designed to expand access. The more completely it succeeded, the fewer people could enter it. That is not a contradiction. That is the mechanism, and once you see how it was built, stage by stage, across 8 decades of policy decisions that each made perfect sense at the time, you will not be able to look at a mortgage rate, a zoning board meeting, or a for sale sign the same way again. If you have ever wondered why earning more than your parents did still leaves you further from the house they bought, the answer is not personal. It is architectural. Subscribe now, because the architecture is the part they never put in the brochure. In 1970, the median American home cost 2.5 times the median annual household income, and that ratio was considered normal, stable, the natural result of a functioning market. Today, that same ratio sits above 6, and most economists will tell you it is a supply problem, a rate problem, a zoning problem, a pandemic problem, a sequence of individual explanations that each make sense on their own, and together leave out the most important part. This is not a story about prices. It is a story about conversion. There is a moment in the life cycle of a public good when it quietly stops being what it was designed to be, without any announcement, without any vote, without any villain clearly visible in the frame. Think about what happens when a community pool built with municipal tax dollars gets privatized. The pool still exists, the water is still cold, the lanes still run the same direction, but now there is a membership fee, and the fee rises every year. And the people who were there at the founding rate pay less than everyone who arrives after them. No one lied. The mechanism just moved. That is the kind of story we are tracking today. In 1934, a federal agency invented a financial product that had never existed before and called it the 30-year mortgage. In 1968, Congress quietly chartered 2 corporations to purchase those mortgages from local banks and sell them to global investors, converting a neighborhood relationship into a tradable instrument. And in 2012, during a period when American families were still recovering from foreclosure, institutional investors purchased hundreds of thousands of single-family homes in under 18 months, establishing a market category that had never existed inside an asset class that was built on the promise of individual ownership. We are at stage 5 of a 5-stage cycle, and stage 5 is the stage where the gap between the cultural promise and the financial reality becomes structural, not temporary, not correctable by a single policy, but load-bearing. The question worth holding before we go further is this: if the system was originally built to expand access, at what precise moment did expanding access stop being the output, and what replaced it? That answer is where we begin. To understand what the conversion cycle is, it helps to understand what it is not. It is not a conspiracy held together by a room of powerful men making coordinated decisions. It is something structurally more durable than that, because it does not require coordination to sustain itself. What it requires is something far more reliable. A large enough group of people whose financial interest aligns with the system continuing exactly as it is. Think about what happens when a city installs a parking meter on a street that was previously free. The first month, people are frustrated. The second month, they adjust. By the 5th year, the meter is infrastructure. It funds the city budget. It shapes commuting patterns. It is written into the assumptions of every business on that block. To remove it now would not just eliminate a fee, it would require rewriting a budget, rerouting traffic, and compensating every stakeholder who built their model around its existence. The meter was a policy. It became a load-bearing wall. This is a policy dependency cycle, and that distinction matters. Each institutional decision in this story was made by people trying to solve a real problem: a credit gap, a housing shortage, a liquidity crisis, and each solution worked. That is precisely what made it permanent. The solutions worked so well that the infrastructure built around them became impossible to dismantle without triggering the problem the solution was designed to prevent. And here is the question that the policy dependency cycle always generates, quietly, in the background. At what point does the solution become more important to protect than the people it was originally built to serve? That is not a rhetorical question. It has a measurable answer. And the measurement is where we are going next. The conversion cycle moves through 5 stages, and the important thing to understand before we trace each one is that no single stage feels like a crisis while it is happening. Each stage feels like progress. Each one produces real winners, and each one narrows the door a little further for everyone who arrives after the stage completes. The first stage is normalization. This is the stage where a basic human need, shelter, is elevated into something beyond a need. It becomes a cultural identity, a marker of participation in the American project, a signal of stability and moral seriousness. This is the stage where renting stops being a neutral financial arrangement and starts being understood as a temporary condition that responsible adults move through on their way to something more permanent. Think about what it meant in post-war America to own a home in a suburb. Rows of houses that all looked roughly the same, built quickly, priced for the working man, and understood publicly as proof that the democratic system produced better lives than anything else on offer. The house was not just shelter, it was the argument. And once it became the argument, the financial instrument that made it possible became invisible, treated not as a policy choice, but as the natural shape of things. The second stage is standardization, and this is where the instrument becomes the institution. In 1934, during the depths of the Depression, a federal agency introduced the 30-year fixed-rate mortgage, a product that had never existed before in American finance. Prior to that, mortgages were short-term, balloon payment instruments, typically 5 to 7 years, requiring large down payments and carrying the constant risk of non-renewal. The new instrument made ownership accessible to a far broader population. It also, in the same motion, defined who qualified, how creditworthiness was measured, what neighborhoods counted as stable collateral, and which communities were structurally excluded from the wealth-building mechanism before they ever entered a bank. The instrument felt like math. It was policy dressed in the language of calculation. The third stage is financialization. This is the stage where the mortgage, previously a relationship between a borrower and a local lender who planned to hold that loan for its full duration, is converted into a tradable security and sent into a global capital system that has no relationship with the specific house, the specific street, or the specific family. Imagine a neighborhood diner where the owner knows every regular customer, extends credit to the ones who have been coming for 20 years, and adjusts the menu based on what the neighborhood actually eats. Now imagine that diner is purchased by a national chain, its menu is standardized across 400 locations, and its financial performance is bundled into a commercial real estate investment trust traded on an exchange in Singapore. The food may taste similar, the relationship is entirely different. That is what financialization does to a mortgage. The borrower becomes a data point in a prospectus, and the lender's primary accountability shifts from the borrower's ability to repay to the security's ability to sell. The fourth stage is regulatory capture, and it is the quietest stage, which is why it is the most consequential. This is the stage where the institutions designed to ensure the housing finance system serves the public begin to structurally prioritize the health of the asset class over the accessibility of the asset. This does not happen through corruption in the dramatic sense. It happens through something more ordinary, electoral math. In a country where approximately 65% of adults own their primary residence, and where that residence constitutes the largest single asset on most household balance sheets, any policy that meaningfully reduces home values is a policy that threatens the financial security of the majority of voters who reliably turn out at every election. The regulator who proposes it is the regulator who does not return. This is not capture by a villain, it is capture by geometry. The fifth stage is stratification, and this is the stage we are currently inside. This is the stage where the gap between those who entered the asset class before stage 4 completed and those who arrive after is no longer a temporary market condition. It is structural. It widens automatically, without requiring active decisions, because appreciation inside the asset class compounds for existing holders, while the entry threshold rises simultaneously. The person who bought in 2005, survived 2008, and held through 2015 exits that period as a net asset holder. Their children, entering the labor market in 2018 with more education and more nominal income than their parents had, find that the entry cost has moved in a direction that their income growth cannot match. This is not a coincidence. This is stage 5 operating correctly. The mechanism underneath each stage is the same. A policy solves a problem. The solution produces beneficiaries. The beneficiaries develop an interest in the solution's continuation, and the political and institutional architecture adjusts to protect it. Now, what does that look like when you trace it across 3 different countries, 3 different political systems, 3 completely different economic contexts? That is where the pattern either holds or it doesn't, and the next case file is where we find out. In the decades following World War II, Japan constructed one of the most remarkable economic expansions in recorded history. And it did so in part by building a financial architecture with a specific structural feature that initially looked like strength and ultimately functioned as a fault line. The feature was this: Japanese banks accepted land as the primary collateral for corporate loans. Land prices rose. Corporations could borrow more against rising land. They used that borrowing to invest in more land and more assets, which drove prices higher, which expanded the collateral base, which enabled more borrowing. This is the feedback loop that does not announce itself as a problem while it is running, because while it runs, everyone inside it is getting wealthier. The corporate executive whose balance sheet is expanding, the bank whose loan portfolio looks solid against appreciating collateral, the government whose tax revenues are climbing, the ordinary salaryman whose small apartment in Tokyo, purchased in 1975, has tripled in value by 1985 and doubled again by 1989. At the peak of that expansion, in 1989, the land beneath a single square mile in central Tokyo was valued at more than the entire state of California. That number was not treated as a warning at the time. It was treated as confirmation. By 1991, land prices began to fall. They fell for 13 years. Not a crash in the dramatic single-event sense, but a slow, compressing, unwinding that hollowed out corporate balance sheets, froze bank lending, and produced what economists would eventually call the lost decade, though the actual duration was closer to 2. What Japan illustrates is what the conversion cycle looks like when stages 3 and 4, financialization and regulatory capture, operate simultaneously without the cultural normalization layer that preceded them in America. The asset became the economy before it became the identity, which meant that when the asset corrected, there was no narrative infrastructure to absorb the adjustment, no policy argument for letting prices find a different level, because the entire financial system was denominated in the assumption of continued appreciation. The American case built the identity first, which made the later stages more politically durable, but also, as we will see, more resistant to the kind of structural reset that an economy occasionally requires to remain functional. The next file shows that same resistance operating inside a democratic system that made an explicit, voted-upon choice to expand ownership and produced an outcome that contradicts the intention so precisely that it reads like a lesson in unintended mechanics. In the years following World War II, Britain built approximately 1.5 million units of council housing, publicly owned residential stock maintained by local authorities, rented below market rate to working-class families. The architecture was not elegant. The policy was not perfect. But the stock existed, it was occupied, and it removed a significant portion of the housing market from the dynamics of speculative pricing. In 1980, the Housing Act gave council tenants the legal right to purchase their homes at discounts of up to 50% below market value, with additional reductions tied to the length of tenancy. The policy was framed with genuine conviction. Ownership confers dignity, stability, investment in community, participation in the national asset base. These are not dishonest claims. For the families who purchased, many of them experienced exactly those outcomes. A factory worker in Birmingham who bought his council home in 1983 at a 40% discount retired 2 decades later with an asset that had appreciated substantially. And that asset became the inheritance that funded his grandchildren's opportunities. The policy worked for the people who were inside it at the moment it was offered. The question that Stage 5 always generates is about the people who arrived after. The council housing stock that was sold was largely not replaced. Local authorities were prohibited from using the sale proceeds to build new units. The stock declined by over 2 million homes over the following 3 decades. And the gap it left was absorbed not by a new public supply, but by a private rental market that was now operating with significantly reduced competition from below-market alternatives. By 2019, research indicated that approximately 40% of homes originally sold under the right-to-buy policy had been converted to private rentals, often occupied by exactly the demographic the policy was designed to serve, now paying market rates, with the government covering the difference through housing benefit payments that cost more annually than maintaining the original stock would have. This is the mechanism the conversion cycle produces in Stage 5. A policy designed to expand ownership creates the conditions for a rental dependency that captures the same population it was intended to liberate, at higher cost to the public, with lower security for the tenant, and with the asset now held by a landlord class whose political interest aligns with rental income continuity rather than ownership expansion. No one voted for that outcome. It arrived through the sequential logic of each individual decision making sense at the time it was made. The third case file is American, and it is the most recent, which means the signals are not historical yet. They are current, and some of the people watching this were on the other side of the transaction we're about to describe. In the years immediately following the 2008 financial crisis, roughly 4 million American families lost their homes to foreclosure. The houses did not disappear. They accumulated on bank balance sheets and in government receivership, sitting vacant in subdivisions across Phoenix, Atlanta, Las Vegas, and Tampa. While the families who had lived in them moved into rentals, doubled up with relatives, or left the markets entirely. The neighborhoods these homes sat in lost value, lost maintenance, lost the ordinary social stability that owner occupancy tends to produce. The Federal Reserve, responding to the economic contraction, drove interest rates to near zero and held them there for an extended period. This solved one problem. It prevented a deeper demand collapse, while creating a condition that would produce a structural consequence no one in 2009 was primarily focused on. Investors who had previously generated returns through bonds, treasuries, and other fixed-income instruments found that those instruments now yielded almost nothing, and they needed somewhere to put capital that would still generate returns sufficient to meet their obligations. Pension funds had commitments. Insurance companies had commitments. Private equity firms had investor expectations. Single-family residential homes, purchased at post-crisis prices in high-growth Sunbelt markets and rented to the families who could no longer qualify for mortgages, yielded between 5 and 8% annually. That yield in a near-zero rate environment was institutional-grade attractive. And for the first time in American financial history, the infrastructure existed to acquire, manage, and securitize single-family rentals at scale. Within 18 months of the first institutional acquisitions beginning in 2012, a new asset class had been formalized, given its own indices, its own analyst coverage, and its own securitization vehicles, single-family rental securities, rated investment grade, sold to pension funds and sovereign wealth funds in markets far removed from the specific houses they represented. In certain zip codes in Phoenix during 2021, institutional buyers accounted for more than 30% of all residential purchases. A family with a pre-approval letter and a 20% down payment sat across the table from an all-cash offer with no inspection contingency from a Delaware LLC, lost the house, and found it listed for rent 6 weeks later at a monthly payment higher than their mortgage would have been. The person who lost that offer is not a statistic. They are a measurable output of Stage 5, operating at scale, and the institution on the other side of that transaction is not a villain. It is a pension fund fiduciary, legally obligated to generate returns for its beneficiaries, doing exactly what the structural environment made rational. The system did not produce that outcome by accident. It produced it because the incentive geometry of Stage 5 made it the logical conclusion. Before we look at what America's current readings actually show, it is worth pausing for a moment, because the pattern either holds across 3 different systems or it does not. And this is the moment to check the frame before we apply it to the present. 3 countries, 3 distinct political architectures, 3 separate time periods covering nearly 7 decades. And in each case, the same 5-stage sequence operating through local materials, different institutions, different language, different electoral pressures, but producing the same structural output. An asset class built to expand access, converted stage by stage into a mechanism that concentrates it. Japan ran stages 3 and 4 without stage 1's cultural foundation, and the correction, when it came, was absorbed by the institutions rather than the identity, which made it economically devastating but politically survivable. Britain ran stage 1 explicitly as government policy, used it to dismantle stage 2's public infrastructure, and produced a rental dependency that cost more than the system it replaced. The United States built all 5 stages sequentially, with each stage creating the political conditions that made the next stage possible, and is now operating inside stage 5 with the full weight of the preceding 4 stages maintaining it. Here's the question worth carrying forward. If the institutions managing your retirement savings and the institutions competing against you for houses are sometimes the same institution, and they are, then whose interest does housing policy exist to protect? And what does that answer tell you about which signals actually matter when you read the next headline about affordability? The current readings in America are not predictions. They are measurements of a system that is already running. And those measurements are specific enough to be worth examining one by one. The homeownership rate in the United States has remained near 65% for 4 decades, even as the affordability conditions that produce that rate have deteriorated significantly. That stability is not a sign of a system in balance. It is a sign of a cultural expectation so deeply installed in stage 1 that it persists as aspiration long after the financial pathway has narrowed. The desire to own is intact. The mechanism for achieving it is operating under conditions the original instrument was not designed for. The 30-year fixed-rate mortgage remains the dominant American housing finance instrument, despite being invented during an economic era with entirely different demographic and mobility patterns. Shared equity models, community land trusts, and adjustable structures with meaningful consumer protections exist as alternatives, but they remain marginal because the regulatory, tax, and secondary market infrastructure is built so completely around the standard instrument that alternatives cannot reach the scale required to matter. Think of a railroad track gauge. The rail system is built to a specific width, and a train designed to a different width can exist, can even run on short stretches of dedicated track, but it cannot access the national network. The 30-year mortgage is the gauge. Everything else is a sidetrack. At the furthest end of the financialization spectrum, single-family rental securities are now rated investment-grade instruments, meaning a 3-bedroom house in a Charlotte suburb is tranched, priced, and sold to institutional investors who will never visit the street it sits on. The distance between the asset and its investor has never, at any point in American housing history, been greater. At the local level, zoning reform, the most direct available mechanism for expanding housing supply, has passed in several states with significant political friction, despite broad consensus among economists across the ideological spectrum that supply expansion is the most durable affordability intervention available. The friction does not come primarily from the construction industry. It comes from existing homeowners, organized through neighborhood associations, planning boards, and municipal elections, using the tools of democratic participation to protect an asset value that the system has made their primary financial security. This is stage 4 operating without requiring anyone to be dishonest or corrupt. It operates through people doing exactly what rational actors do when their financial survival is tied to a specific outcome. And at the generational level, the homeownership rate for Americans under 35 has reached its lowest recorded point. The equity held by Americans over 65 has reached its highest. The asset is concentrating inside the cohort that entered before stage 5 completed, and the transfer mechanism running in the other direction, intergenerational wealth transfer through inheritance, is now a more significant predictor of homeownership access than income growth, education level, or geographic mobility. The floor, as each generation discovers, was already higher when they arrived. What moves a system like this from one stage configuration to another is not a headline or a rate decision. It is a shift in the underlying geometry of incentives, and that shift has its own specific anatomy. The conversion cycle does not reverse from within. and it does not transition through the kind of dramatic single event that produces clear before and after photography. It transitions when one of three pressure types accumulates enough structural force to alter the incentive geometry that holds the current stage in place. And none of those three pressures is currently operating at meaningful scale. The first is supply shock, a sustained, politically durable increase in housing production that outpaces demand growth for long enough to shift price expectations. This requires zoning reform, construction capacity, and financing structures for new development to align simultaneously in enough markets, for long enough to generate a new expectation of supply adequacy. No prior period in American housing history has achieved all three of those conditions at the same time. They tend to solve sequentially, with each solution generating a new bottleneck before the previous constraint is fully resolved. The second is demand compression, a sustained decline in the size of the population cohort actively entering the housing market, driven by demographic rather than policy forces. Japan's transition after 1991 was partly this: a peak homebuying cohort moving through the system and a smaller cohort behind it unable to sustain price levels. The American millennial generation is the largest birth cohort in national history and has not yet reached its statistical peak homebuying years. The demographic pressure that might produce demand compression is not building in a direction that suggests near-term impact. The third is institutional exit, a shift in the yield calculus that makes institutional single-family portfolios less attractive than alternative assets, potentially driven by rising property taxes, rent regulation at scale, or a normalization of interest rates that makes fixed-income alternatives competitive again. Institutional exit would lower acquisition pressure in the markets where it is currently concentrated, but it would also withdraw a significant source of rental supply simultaneously, creating a transition that affects both the purchase market and the rental market in the same window, in ways that may be disruptive for both buyers and current renters before they are beneficial to either. The current configuration is characterized by the absence of any of these three forces activating at sufficient scale, which does not mean the system is stable in the way a fixed structure is stable. It means the pressures are accumulating rather than releasing, and accumulating pressures have a different relationship with time than announced policy changes do. Understanding that difference is not a financial question. It is a question about the quality of attention you bring to the environment you are already living inside. And that is exactly where the final section of this analysis sits. There are three orientations a person can take toward a system that operates at the scale and duration we have just traced, and the system has answers for two of them. The first orientation is to continue inside the cultural script that Stage 1 installed, to treat housing unaffordability as a market irregularity, a temporary regional condition, a problem of personal financial timing or readiness. This orientation is comfortable, and the system is designed to accommodate it. The aspiration remains intact. The instruments remain available, at terms the market will bear. The cultural framing that homeownership is achievable for those who prepare properly has not been officially revised. The system functions adequately for people who navigate it from within this orientation, provided the timing and geography cooperate. But it does not give them the ability to distinguish between signals that indicate genuine transition and signals that are noise, because it does not acknowledge that the stage structure exists. The second orientation is to engage the issue through the political and emotional framing that most media applies to it, to identify the specific actor whose behavior is most visibly proximate to the affordability problem, direct attention and energy toward that actor, and measure progress by the volume of the response. This orientation generates high engagement and low structural leverage. The institutional investor who outbid a family in Phoenix is a real phenomenon with real consequences, and the anger directed at it is not irrational. But the institutional investor did not design Stage 1, 2, 3, or 4. It arrived in Stage 5 and behaved the way Stage 5's incentive geometry made rational. Removing that actor does not change the geometry. It changes the occupant of one node in a system that will fill the node with whoever fits next. The third orientation is to understand the stage structure specifically enough to recognize which policy signals, demographic readings, and institutional movements actually indicate transition and which are the system's ordinary operations being covered as though they were disruptions. This orientation does not guarantee any particular outcome. It does not tell you when the transition comes or what form it takes. What it gives you is a different quality of attention, the ability to read the environment without being managed by the environment's preferred framing of itself. The system has very little difficulty managing the first two orientations. The third is less legible to it, which is precisely what makes it worth developing. The conversion cycle took approximately 80 years to move from stage 1 to stage 5 in the American context. That duration is worth holding for a moment, because it means that almost no individual who participated in the construction of any stage was present for the full consequence of what they built. The policymakers who designed the 30-year mortgage in 1934 did not live to see a single-family rental security. The architects of the secondary mortgage market in 1968 did not design Stage 5. They solved the problem in front of them, in the institutional context available to them, in ways that were rational at the time and compounding in ways that were not their primary concern. This is what makes the conversion cycle more instructive than a story about intention. It is a story about how systems accumulate logic, and how that accumulated logic eventually becomes the environment inside which the next generation makes its decisions, not as victims, not as conspirators, but as participants in a structure they did not design and were not given a clear diagram of when they arrived. The motif that runs underneath this entire analysis is not about collapse or correction. It is about elevation. The system does not lock the door. It raises the floor. Each stage raises it a little further. And the people who are already inside rarely notice because from their position, the floor looks like it has always been where it is. The people arriving notice immediately, but the cultural framing installed in stage 1 tells them the problem is their preparation, not the floor's position. The system does not care whether you believe in it. It ran before you were making decisions, and it will continue running through whatever opinion you form about it today. That is not a reason for despair. It is a reason for precision, because the kind of attention you bring to a system determines what you are able to see inside it, and what you are able to see determines the quality of the decisions available to you. Think about a family reading a utility bill for the first time with a genuine understanding of how the rate structure was set, not the number at the bottom, but the regulatory history that produced the number at the bottom. The bill has not changed. What has changed is the reader's relationship to it. They are no longer a passive recipient of a system they cannot see. They are someone who understands the mechanism well enough to know which part of it might, under the right conditions, be different. The question worth sitting with, not as provocation, but as genuine structural inquiry, is this. If the primary wealth-building vehicle for the American middle class requires prices to continue rising in order to function as a savings mechanism, and rising prices are precisely what makes that vehicle inaccessible to the next cohort, then the system is not failing. It is succeeding at one objective while producing a consequence that was never written into the original design document. The question of whose interest that consequence serves and whose interest it costs is not a political question in the partisan sense. It is a structural one, and the structure is public record. The floor is still moving, slowly, structurally, without announcement. The next phase of this cycle will not arrive as a headline. It will arrive as a reading that either makes sense within this framework or requires the framework to be revised. And on this channel, we continue tracing the mechanism as it evolves, because the most useful thing structural analysis offers is not a prediction. It is the capacity to recognize a pattern at a distance, before the pattern is close enough to make recognition feel urgent.